Silver just crashed 36% from its all-time high. Gold dropped over $1,000 from its peak. Everyone is panicking, but here is what no one is telling you. The biggest banks and institutions on the planet are not selling. They are buying. And by the end of this video, you are going to understand exactly why this crash happened, who caused it, and the 3 signals smart money is watching right now that could make this the single greatest buying opportunity for silver and gold in over a decade. If you are holding silver or gold right now, or you have been thinking about buying, you need to watch this entire video because what I am about to show you changes everything. Let us start with what actually happened because the mainstream narrative is completely wrong. Right now, as of today, silver is trading around $81 per ounce. Gold is sitting just above $5,042 per ounce. Now, those numbers sound impressive until you realize where we were just 10 days ago. Silver hit a record high of $121 per ounce on January 29th. Gold was pushing past $5,500. Then in a single trading session, silver suffered a 31% crash. That is not a correction. That is not a normal pullback. That was the worst single day for silver since the Hunt brothers tried to corner the market back in 1980. So what happened? The mainstream media wants you to believe this was a simple reaction to Donald Trump nominating Kevin Warsh as the new Federal Reserve Chair. They want you to think the market just repriced because a hawkish Fed chair means a stronger dollar and lower precious metals. And yes, that is part of the story, but it is a tiny fraction of the real story. Here is what actually triggered this crash, and this is the part they are not telling you on the evening news. The CME Group, which runs the COMEX exchange where silver and gold futures trade, raised margin requirements 6 consecutive times during this cycle. 6 times. They raised initial margins on silver futures from 15% all the way up to 18%. That means every single leveraged trader holding silver futures suddenly needed to come up with millions of dollars in additional collateral over a single weekend. Most of them could not do it. And when you cannot meet a margin call, there is only one option. You are forced to sell at market price, at whatever price someone is willing to pay. That created a cascading liquidation event. Forced selling triggered more margin calls, which triggered more forced selling, which triggered even more margin calls. It was a self-reinforcing downward spiral, and it had absolutely nothing to do with the actual supply and demand for physical silver and gold. Let me say that again because this is critical. The crash was a paper market event. It was leverage being unwound. It was not a collapse in demand for the actual metal. Before we go any further, smash that like button right now and tell me in the comments how many ounces of silver and gold you are holding through this crash. I want to see who has been stacking through this chaos. Drop your numbers below and subscribe if you want daily silver and gold market updates because this story is far from over. Now let us talk about the Kevin Warsh factor because this is where it gets really interesting. Kevin Warsh served as a Federal Reserve Governor from 2006 through 2011, right through the heart of the Great Financial Crisis. His reputation is built on being a deficit hawk. He opposed quantitative easing. He warned about inflation when nobody else would listen. He resigned from the Fed in 2011 because he believed they were printing too much money. So when Trump nominated him to replace Jerome Powell, the market immediately assumed the worst. Stronger dollar, higher rates for longer, the end of easy money, and precious metals sold off hard. But here is the part that everybody is missing. Kevin Warsh today is not the same Kevin Warsh from 2011. In recent interviews leading up to his nomination, he has actually said, quote, "We could lower interest rates a lot." He has talked about getting 30-year mortgage rates down to make housing affordable again. He has positioned himself as an ally to the White House, not an adversary. Think about this logically. Donald Trump fired Jerome Powell because Powell would not cut rates fast enough. Do you really think Trump would then go and appoint someone who is going to keep rates high and fight him at every turn? That makes zero strategic sense. What I believe is happening, and this is just my analysis of the situation, not financial advice, is that the market massively overreacted to the Warsh nomination. The smart money understands this. That is why, while retail investors were panic selling their silver ETFs last week, the biggest institutions on Wall Street were doing the exact opposite. This is where it gets exciting, and this is the information gap that nobody else is covering. Let us start with the banks. UBS just raised their gold price target to $6,200 per ounce for the first 3 quarters of 2026. That is up 24% from their previous target of $5,000. Their upside scenario, if geopolitical tensions escalate, is $7,200 per ounce for gold. Deutsche Bank and Societe Generale are both projecting $6,000 gold by year-end. Goldman Sachs lifted their target to $5,400. Now think about what that means for silver. Before this crash, the gold to silver ratio had compressed all the way down to roughly 31-1. That is a level we have not seen since 2011. Historically, when we are in a sustained precious metals bull market, silver outperforms gold once the shakeout is complete. If gold is heading towards $6,000 or higher, silver at $81 today looks like an absolute gift. But it is not just bank forecasts. Let us look at what is happening on the ground. Peter Brandt, a 50-year commodities trading veteran who actually predicted this crash by comparing the current spike to the 2011 blow-off top, has now tactically flipped bullish. He saw the crash coming, called it, and is now saying the setup from here is incredibly attractive. The Silver Institute has projected a 5th consecutive year of structural supply deficit in the silver market. Let me repeat that. 5 straight years where demand exceeds supply. Fresnillo, the world's largest primary silver miner, just cut their 2026 production guidance to between 42 and 46.5 million ounces. That is down from their previous guidance of 45 to 51 million. Hekla Mining's 2026 guidance also came in below 2025 output. The miners literally cannot produce enough silver to meet demand. And here is the kicker. While paper prices crashed 36%, physical silver premiums at dealers barely moved. In fact, multiple major dealers reported being completely sold out of physical silver by February 1st. When the paper price says one thing and the physical market says the complete opposite, that tells you everything you need to know about what is really happening. Quick reminder, if you are getting value from this video, hit subscribe and turn on notifications because I am covering silver and gold every single day this week. Comment below with the word stack if you have been buying this dip. I want to hear from you. Now here are the 3 specific signals that institutional investors are watching right now that will determine whether this crash becomes the buying opportunity of the decade. Signal number 1 is the silver lease rate. Under normal conditions, 1-month silver lease rates sit between 0.3 and 0.5%. In January 2026, that rate exploded to 8%. 8%. When someone is willing to pay 8% annualized just to borrow physical silver, that tells you one thing. There is a severe shortage of actual metal. The paper market can say whatever it wants, but when lease rates are at 8%, the physical market is screaming that silver is scarce. Smart money watches lease rates, not spot prices. Signal number 2 is the COMEX delivery data. JP Morgan was heavily involved in February deliveries, totaling 633 contracts at an average price of $78.29 per ounce. When the biggest bank in the world is taking physical delivery of silver during a crash that is not bearish, that is about as bullish as it gets. The institutions are using this paper market weakness to accumulate real metal at discounted prices. Signal number 3 is central bank buying. China's central bank extended its gold purchases for the 15th consecutive month in January. 15 straight months of accumulation. And it is not just China. Emerging market central banks across the globe are accumulating both gold and silver as strategic monetary assets. When central banks are buying, they are not doing it for a quick trade. They are positioning for a fundamental shift in the monetary system. Silver is being reclassified from a simple industrial commodity to a triple identity asset: industrial use plus monetary metal plus strategic national resource. That reclassification changes the entire valuation framework. Here is the part that makes this even more compelling. Even if you completely ignore the monetary case for silver, the industrial demand story alone is staggering. Global solar capacity in 2026 is projected to reach 665 gigawatts. Silver is the most electrically conductive metal on the planet, and it is non-negotiable for photovoltaic cells. Solar manufacturers do not care about short-term price volatility. They need silver, period. Electric vehicles use significantly more silver than conventional cars. AI infrastructure requires massive amounts of power, which increasingly comes from solar and nuclear. Nuclear reactor control rods also require silver. As the world pours hundreds of billions of dollars into AI data centers, clean energy grids, and nuclear capacity, silver demand is being locked onto a long-term trajectory that is practically impossible to substitute. This is what creates the asymmetry. The paper market crashed because leveraged speculators got liquidated, but the fundamental demand drivers did not disappear for a single day. Solar panels are still being manufactured, electric vehicles are still being produced, AI data centers are still being built, the supply deficit is still growing. Nothing about the structural bull case for silver has changed. What changed was the price you can buy it at. So where does this leave us? Let me break it down simply. Silver is trading at $81 per ounce today. Just 11 days ago, it was at $121. That is a 33% discount on an asset where the biggest banks in the world are projecting massive upside. The supply deficit is getting worse, not better. Industrial demand is accelerating. Central banks are accumulating. Physical dealers are running out of inventory. And margin-induced liquidation, which caused this crash, is a one-time mechanical event, not a repeating fundamental problem. The last time silver crashed this hard from an all-time high was 1980. In the years that followed, silver consolidated and eventually began one of the greatest bull runs in commodity history. Every single time precious metals have experienced a leverage-driven crash during a structural bull market, the recovery has exceeded the previous highs. Now, I am not telling you what to buy or when to buy it. This is market analysis and news reporting, not financial advice. What I am telling you is that the information the mainstream media is feeding you about this crash is incomplete at best and misleading at worst. The real story is not that silver crashed. The real story is why it crashed and who is buying the dip. The smart money has spoken. The question is whether you are going to listen. That is going to wrap it up for today. If this video opened your eyes to what is really happening in the silver and gold market, do me a favor and smash that like button. It helps this video reach more stackers who need to see this information. Drop a comment below telling me your silver and gold strategy right now. Are you buying this dip or are you waiting? I read every single comment. Subscribe and hit that notification bell because I am breaking down silver and gold news every single day. And in my next video, I am going to reveal the specific price levels where institutions have placed their biggest buy orders. You do not want to miss that one. I will see you in the next video. Keep stacking.